Hey everybody, welcome to this month's edition of Powell & Associates Broker Bytes. Today we're going to dive into something that is on everybody's mind here lately, and it is the mortgage mayhem that has been going on. So I went straight to the professionals to talk with us about what's going on, their opinions, tips, to help give all of us a better idea of what's going on, what to expect, and not to be so scared of everything. A lot of the news doesn't share the specifics, and they tend to scare everybody, and there are still very easy ways to get a loan and buy a home, and that's what we're going to do today, is kind of inform everybody and educate everybody so that they know the truth and not what all the news reporters are out there scaring you to death about. Welcome to Broker Bytes. I'm Nancy Powell, realtor, broker, and CEO of Powell & Associates, located in the beautiful and historic heart of the CSRA, Augusta, Georgia. Broker Bytes will merge my passions of community involvement, business, and real estate. And I'll combine real estate market updates, local news, hometown happenings, and the best scoops, as well as useful information for the buyer, seller, and investor in the CSRA. With me today, I'm going to start with Jeff Conzett. He's with Colony Bank. Then I have Pamela Bean, and she's with Frontline Capital Mortgage. And then I have Cliff Jennings, who is with Movement Mortgage, and they are the best of the best. And, of course, I'm Nancy, so, you know, I'm the best of the best, too. So, you know how that goes. But anyway, so we're going to just dive right in to this. And I wanted to wait until the Fed came out with the 0.5 percentage rise in the interest rate. So I wanted to do this after that happened, because that hasn't happened in like 40 years. And so, and kind of start there with the impact of what that is. I know that the interest rate, or their rate, has increased by 0.5%, but that doesn't necessarily mean that it's going to go into the mortgage rates right away. Mm-hmm. Right. It'll be a, what's that word they like to use about a year ago? Transitory. We were just in a transitory position that's been going on for 2 years. But anyway.
The new normal.
The new normal. So to hear that the feds have increased the interest rate by 0.5% scares people. They're like, oh my gosh. But that's not necessarily, in my opinion, and I'm not in your world. Y'all know much more about all this than I do, but from a real estate aspect, in my opinion, this is not completely a bad thing, because I actually think it's going to not slow down the housing market to like a stop to where the bubble bust like it did in 2008, but it'll bring it back to a normal where you won't have 30 people bidding $100,000 over asking price. So I'll let whoever wants to start talking about that first, and their opinions of the interest, the rate hike, and what you think that's going to do to mortgage rates and things like that. So who wants to go first?
I'll pipe in
Ladies first.
Thank you.
So you're right. The Fed's increase in the rate is not a direct impact on mortgage rates. The Treasury bond is what really drives the mortgage rates. And when the yield changes with the Treasury bond, when it goes down, then our rates go down. So inflation is a little bit more of a drive for the Treasury bonds than what the Feds do. Mm-hmm. Now, Can it affect it? Yeah. So the Fed rate affects ARMs. It affects the adjustable rate mortgages. But for the fixed rates, we follow more what the Treasury bond is doing.
Okay.
And that's a lot of information for the average person.
Right.
Yeah.
But there's no reason to be so frightened
Right.
because the Feds do. And there was a knee-jerk reaction. There was definitely a knee-jerk reaction. The very next day, there was a spike in the rates. Mm-hmm. I don't know
Just
why.
because everybody deals with, they
Yeah,
react
that
based on
response.
emotions. And,
Well, it was a little funny that reaction happened the day they made the increase. We saw some positive movement.
Yeah.
Oh, yeah.
we did.
Yeah, that was a
rates
good
were
day.
great
And
for a
everybody
day.
thought, well, it was anticipated they were going to do this 50 basis point
Mm-hmm.
hike.
Right.
The good news was they didn't do more.
Mm-hmm.
But then when we had that reaction the next day, that
Right.
was
We were all like,
Yeah,
that
and,
was a little crazy.
and it's that reaction that always makes people think that the Fed exactly impacts the
That's
mortgage
exactly
rates.
right.
And when in reality, it's a trickle effect. It affects,
Mm-hmm.
like you said, the ARMs. It affects more of the, I call it the bank rates, the consumer loans, the car loans and the personal line of credit and all that sort of stuff, much more than it affects the mortgage industry. So, of course, yeah, there's that trickle effect. But I'm glad we're talking about that first, because that's actually probably the question I get asked most is, well, hey, this increase, and I saw that this happened, and I'm like, well, time out, pump the brakes. It doesn't work that way.
so why do they automatically, do y'all think, go to that? Just because they think it's all connected?
It's what you hear about.
Yeah,
Yeah.
it's all, yeah. Because, 2 or so years ago, when all of a sudden the rates went down to 0%,
Right.
my
Yeah.
phone started blowing up. I want to get that 0% rate. I'm like, time out. Like, the 0% rate literally does not exist.
Got any more of
Right.
those?
If the 0% rate was a thing, I mean, then we wouldn't have jobs.
That's right.
I mean, the banks wouldn't have money
Get
because
paid
the banks
commission
have
on
to make money. It'd be an IOU. But yeah, so the good that we're talking about that first. The Fed rates don't exactly and immediately affect the mortgage fixed rates.
Yeah, so what we've seen since last Wednesday and that spike is the rates coming back down. So what I priced
Good.
today looked like they looked Thursday over a week ago.
Yep.
Right.
So again, that's
Which is, what is today's 30-year fixed rate?
30-year for a $200,000 loan, 780 credit score. Putting 20% down was like right at 5.5.
Yeah, that's about the
Something in
same.
that range.
Yep.
Yep.
Yeah, I
Seems
quoted one this
reasonable to
morning.
me.
Yeah, quoted one this morning, 5.5, no point. I think it was like 5.25 with a point or
That's
something,
right.
something like that.
That's right.
So not
Not terrible.
too terribly bad. I think we've gotten to, I think what has happened is we've become so accustomed to the 2s and the 3s that we're scared. I mean, that when it goes to a 5, people start freaking out, especially the generation that
The
is the
younger
next
buyers. Yes.
huge buying
Yes.
class, which is millennials. They're like, oh my gosh, the world is ending. It's gone to 5%. So my question I want to ask each one of you, and I'll start with Jeff, what was your first interest rate on your first home?
Wow. I think I want to say it was about 5.5,
So you're about where
and that
we
was
are.
on a 15-year mortgage. So I thought I was stealing money at that point.
Pam.
7.5. Putting 20% down. Excellent credit. 1991. 92. I'm sorry. 92.
Very first one, this is, I'm probably actually part of the housing crisis because, I mean, no joke. I still looking back, have no idea how my wife and I got a loan, but we got a 100% financed conventional loan
Nice.
at a,
Was that in 2008?
it was
dear?
2009.
Okay. That makes a lot of
So,
sense.
but yeah, 4.75, 100% financed conventional.
That's
You
pretty
just
strong.
have to breathe at that
And
point.
I have no
during
idea how
those
that happened. But I will say, we just moved a year and a half ago, but prior to that, we bought, and my rate was 5.625.
Right.
And I
My
thought that was
first-
great at the time.
My first rate, 2001, same as Pam, 7.5. And I thought, wow, that's a great rate. Because my parents, for years, who are baby boomers, 18, 19, 20%.
Right.
So so then they look at me and like, man, you're getting a deal for 7.5%. So that, that's kind of interesting. And, I wanted to point that out to put things into perspective that, while this generation of millennials think that the rates are so high, they really are not that high in the grand scheme of things. And actually, it's going to help them, especially if they're first-time home buyers, because with the rates going up, it's going to deplete all that rush and all that multiple people putting a bid on one house. If somebody can afford the payments on a $200,000 house at 5.5%, a lot of those people, now that the interest rates have gone up, can't afford that, so it's going to knock them out. So then that's less that you have to compete with. So that's better odds for them to be able to get the house that they want. That's the way I look at it anyway. It's not all bad with it, with it increasing some. And I also think, and I'll start with Jeff after I make the point that I'm going to make, is I actually think this is going to cause a market correction that we really need. Jeff?
I think there's definitely something to that. So I think recently, and everybody will agree, I think a lot of people started putting their houses on the market because the prices were so inflated. It's like, hey, I'll put it out there for a make-me-move price.
Mm-hmm.
But I think the rate environment's going to kind of chase some of those people out of the market, because here they are, they owe whatever they owe on their house at 3.25%. And yeah, they could make some extra money on their house, but then they're going to have to go overpay for the next one and pay 5.5% on their interest rate. So I think it's going to chase some of those people out of the market, and it may correct what I think, Cliff and I were talking about it earlier, is a bigger problem, and that's the inventory.
Mm-hmm.
There just aren't enough houses out there. So the competition for those houses is so fierce, it's driving the cost up, which, especially for your first-time home buyers, I think is a bigger problem.
So more affordable housing is needed.
I would agree with that.
If we can achieve that.
If we can achieve that.
Pam, what are your thoughts on?
I agree with him, but I was going to share a little good news. So for April inventory, even though it was 12% lower than March, it's still the smallest year-over-year decline since the end of 2019.
Wow.
So glimmer of hope.
Yeah.
Right, that the inventory could be turned around. And I definitely think we need more in the $150,000 to $250,000 range for sure.
I do too.
100%. Yeah.
Yeah, because that's going to be the tougher client. Their income's going to tend to be lower. So then we have to look at their debt to income, and we need more homes that are in the affordable range. And like you and I talked on the last podcast, is going to be what's the monthly payment that they can afford.
Yeah.
And that's going to drive what the purchase price is going to be, not the interest rate. I mean, interest rate is going to be what it's going to be.
What it's going to be.
Right.
We can't
So our
change
job
that.
is to find, what's your sweet spot for purchase price, and then, take it back to the realtor, and this is what you need to find for them. So then we need that inventory.
And I will say, before I let Cliff talk, is I have noticed in the last couple of months an increase in listings as well. Normally, this is the time of year that people start listing because school's getting out and people are moving and whatnot. And then, with our military here, they're moving to other locations because I think April is one of the PCSs and October's the other one. I have noticed an increase. Now they get gone. They still get gone quick. But I have noticed an increase of inventory over the past couple of months. So that's a little bit of glimmer of hope too. But Cliff, what do you think as far as do you see any light at the end of the tunnel?
I definitely see light at the end of the tunnel. Kind of touching on one thing that Jeff said, I think, yes, it's going to correct some inventory issues. Obviously, we all know that there's been inventory issues. One thing I guess a glimmer of hope is we will not have a massive housing crash. We've in 2007, 2008, we had the opposite problem. We had, say, 10 homes for every one buyer. And so the inventory just sat and it sat and it sat, and people are moving, and then they can't afford 2 payments, and then and everybody was upside down on their house. And so that's not going to be the case right now.
No predatory lending.
Yep. Yeah. And so a lot of the, with these higher rates, some of the not so serious buyers are going to back out and go, I'll just stay where I'm at. I'll just wait. But to me, another huge thing that we can all agree that the last 2 years have just been pure chaos as far as like applications coming in, the process to getting them through. And so one thing just from a customer service standpoint is the client right now is going to get a much better service, in my opinion, than they have gotten the last 2 years. A friend of mine in Athens with our company, I was telling him kind of probably about a year into the whole mess, I was like, I don't know about you, man, but I feel like I just suck at my job right now. And he's like, dude, me too. I thought it was just me. And I was like, because it's just, where normally we would provide an update call or an update, whatever. It's just when there was just so much volume rolling through, it wasn't just the loan officer, it was the loan officer and then their assistant and the processor and the underwriter and the closer and the appraiser
and
the realtor and the home inspector. And so there was everybody from beginning to end was just
because I've had
overwhelmed.
Some clients say, I want to go look at this house. Don't you have somebody else in your office that can show me? And I'm like, well, first of all, I'm not passing you off to another realtor because you're mine. And, that's not how it works. But I was like, no, you're just going to have to wait. But in the last 2 years, you can't wait. You've got to be ready. You got to be sitting on go. And, you put in an offer and you've got your pre-approval and you just keep your fingers crossed and hope that they choose yours and, let it ride. But you're exactly right because it's, I think all four of us pride ourselves on putting our clients first and making sure that they understand every single step of the process and what's going on and follow up and don't let them fall by the wayside or, make sure that they're comfortable with everything that's going on. And dealing with so many clients at one time kind of is hard to do, so then you go into making calls at 8, 9, 10 o'clock if they're up, things like that, getting up at 4 o'clock in the morning to get work done before the phone starts ringing.
Yep.
That's right.
And things like that. But, so I think that's a glimmer of hope too. Not that we haven't provided great service, but it's been strained to a certain extent. And when those first-time home buyers go to buy their second one, they're like, that's not what we did.
Yeah.
Wait a minute, that's not what we did the first time. Okay, the first time was a different story.
Yeah.
We're going to do it a whole different way this time. But anyway, you're right. And I think, with us, that's the most important thing is our clients, and we want to make them happy, and we want to provide them with the best thing. The other thing I kind of want to touch on, and I want y'all to help me out here, is with the interest rate going up, there are going to be some additional challenges other than making sure you have the winning bid, such as if you have enough money in savings, you can buy down your rate and still have a lower rate than what is currently going. So I'll start with Cliff this time. Are there a few 2 or 3 tips that you could give me with, couples that are one person that is buying their first home, as far as things that they could start doing that it may take a few months, but they could, put things in order to ensure that, if their interest rate's higher, they may get of course they're going to get a better rate, savings, things like that. If you could, a couple of tips that you think would be some good advice.
I think, 2 things immediately come to mind. One would be credit. Right now, good credit's way more important than it has been. If you had terrible credit, a year and a half, 2 years ago, you still get a 3% something rate.
Yeah.
But right now, those that have lower credit are getting hit harder. So definitely work on credit just to maximize that low rate potential, right? And the second thing would be having some additional money, not just to put down for down payment, but to throw at a couple different things. Like you mentioned, a discount point and buying your rate down. You know, for a long time now, I've not been a fan of discount points. Normally, it's not worth it in my opinion. Every once in a while, you know, I'll run the numbers. I'm like, oh yeah, that's worth it. But here recently, I mean, I just had somebody, they came to me and said they had all this money they wanted to put towards discount points. And it ended up being about 4 discount points. It was slightly over. And in my head, I'm going, this is ridiculous. This is the dumbest thing I've ever seen. I'm not going to let this guy waste his money. But then I looked at the numbers and ran the numbers. And as long as he was in that house for 24 months, he made the money back. 24 months. Wow. And I was blown away. And I, like, never in a million years did I think spending $10,000 in discount points for someone who, like in his case, was going to be in that house for a long, long, long time. That was his plan anyway. Okay, well, now that makes sense. So having some extra money to play with, and then there's another trick that I use that I'll share with y'all off the national scale of who could hear the podcast, because I can't tell my secrets to everybody. But it's everybody has heard of mortgage insurance and the devil that it is. And I always tell my first-time home buyers, mortgage insurance is kind of like Satan. Everybody has to deal with them. Nobody likes them. It is. Yeah, and so everybody has to deal with mortgage insurance, but there's some tricks to not necessarily get out of the mortgage insurance, but to get around the monthly mortgage insurance. So ask your lender those questions as well.
Pam, any tricks up your sleeve?
I definitely think credit score is first and foremost. I would say reach out to a loan officer if you're a first-time buyer and go ahead and make that relationship now. Now's the time to get prepared. So it may be not today, but let's get a plan in place. So 3 months from now, and maybe the interest rates will be down. Credit score is definitely one.
And they can look at your credit report. I know we've discussed this. They can look at your credit report, and there may be just some minute things that
would make a big
if they
difference.
Paid off, it would make a huge difference in raising that score, right?
Paying things on time, yes. Making sure they have the trade lines on their credit score, because you know some people don't want to have credit cards. Well, credit cards actually help if you take care of them like you're supposed to. So that's definitely the first thing. And then we have to look at debt to income. So that's not going to make a difference in the rate, but it's going to make the difference in whether you qualify for a house or not, and what payment you can afford, and then saving the money for the down payment, because that will make a difference. Higher credit scores and being able to pay more than just the minimum down payment is going to get you a better interest rate, which is going to pay off in the long run.
I'll interject here and make sure that everybody listening knows you do not have to have 20%.
You don't have to
down
Very true.
to buy a house.
Always nice.
It is nice to do, but you don't have to.
You don't have to have it. And, it's not a huge hit if they pay the minimum down payment, but their interest rate is going to look better because their loan to value will be in a better position. So those things definitely to consider.
And that's the situation where your payment matters. As far as looking at debt to income, that's more important than your interest rate, because it doesn't matter what your interest rate is if, as long as you can afford it with your debt to income, then who cares what your interest rate?
Home buyers, I would also say, is there a non-occupant parent that can be on it with you? Because of that, they can be, and they're willing to trust you in taking care of it, but they can be there just in case. Sometimes their income can help qualify.
Kind of like a cosigner type
exactly.
deal.
Right.
I hadn't thought about that.
I should have shared that with, with the guys that remember. But it's definitely, and the ones that I've done have done pretty well, because parents, it may not be their credit score that qualifies. Often it's the first time home buyer, because theirs might be a little lower. That's just how it works.
Because they have more debt.
Yeah, but the income of the parent can help them.
And it also, kind of going back to mortgage insurance, it lowers the risk. So the mortgage insurance a lot of times is a lot cheaper if there's, say, a cosigner that's well off, high credit with, no debt or something like that. That could really help.
Jeff?
No, actually, they pretty much covered it. The one thing I'll say is...
I'm sorry.
No, the one thing I'll say is that 100%, every situation is going to be different.
Yes.
So the big thing is get with the loan officer,
Yes.
loan originator, whoever it is, and understand what your credit score is. What can I do to improve it? Why would that make a difference? What difference would it make? If I do have some assets and I'm a first-time home buyer, maybe taking some of those assets that I was going to buy a rate down with and paying off another debt would make a bigger difference in my monthly outlay.
Preach.
Everybody's different.
Yeah.
So get with somebody so
Yeah.
you can take a look at it and really understand.
And I know
what
all
you
of
need to do.
y'all do this because I've worked with all of y'all, but it's important to find a loan officer to work with that is flexible like that is not just, okay, your credit stinks and you don't have any money, so goodbye, walk out the door.
Okay, bye.
Yeah, see you later. Whereas my experience with y'all and others too is, okay, we can't do it this way, but let's put our thinking caps on. Let's see if we can't come up with a different way to do it. And then the famous saying, I'm not saying never. I'm just saying not right now. So,
It
and
takes
that
time sometimes.
yeah, it does. And they, we have to consider that a lot of them haven't ever been taught financial literacy or
No.
to save.
Pretty much
or,
everyone has never been taught
Yeah.
about credit or
That could be
financial
a good
literacy.
class to throw into high school curriculum.
Yeah.
Absolutely. Absolutely. So I read something the other day, and I could be completely off, but there was something because there is a lot of investors that are inundating our market and they're buying up those price 150 to 250. They're buying it up and pushing those first time home buyers out because they can pay cash. So what I read was there were some new loan products coming out that would put that buyer into a position of being a cash buyer essentially. So then that wouldn't even be an issue. Did I read that in my sleep, or is that a thing?
I'll be honest with you, I've seen it. It's not something that we're currently offering, but it is out there. I don't know enough to speak on it with much.
Yeah, I think all three of us just squirmed in our seats a little.
Yeah. What I saw, it wasn't very attractive. It had, it accomplished the goal you're speaking of, but let's just say it has some strings attached to it.
How does it? But I don't understand how it works.
So there's one, I won't say the name, but there's one that locally here in the Augusta area is used often. But it's essentially, think of it as if I'm buying a house and you have lots and lots and lots of money, you're going to lend me your cash, but you're going to charge me to use that cash. And so I might be able to make a cash offer to, say, Jeff, who's selling the house. So I get my offer through, but then not only do I have to still get a mortgage within a certain length of time, but I also have to pay you back with fees attached,
Right.
with money
That
coming
doesn't
back.
sound good at all.
Sounds
and
a little
so-
like loan sharking.
Yeah.
I don't know if I go that far.
Yeah, I wouldn't say it's quite that, but I think there's probably some situations that it makes sense. You know, you talked about people PCS and military folks. I mean, the military, they have a very small window of time to accomplish a goal of finding a house and
Right.
moving. And so, somebody in that situation might be a good thing. I actually had a call this morning talking about just the uncertainty of these cash programs. When it comes to FHA loans, depending on how long the seller has been in the house that you're buying, it could run into the FHA flipping rule if title changes hands too many times. So it could be that if you're looking at FHA loans and then you start looking at one of those cash offers, then it doesn't work at all because of the FHA flipping rule.
And then I'm not sure if FHA does it, but I know VA, if you are a veteran too, you could assume their mortgage so you could keep their interest rate, which may be lower. So that is something that to me is good. I mean,
Yeah. I think loan assumptions will definitely become popular in the next couple of years.
just because of the rates have been so low.
Yeah.
For what it's worth, if the Fed keeps raising rates and they can do something else with their money and make some money, maybe they'll get out of the
Yeah.
buying up the real estate.
True.
May take a minute.
Disclaimer here, I'm not kin to Chairman Powell
Oh, come on.
at all. So as far as regulation, I know it's been tighter since 2008, 2009, just because that was, I can't say that on my whatever, but a beat show. There was no regulation whatsoever. And then I know that they released it, they eased up some. Now, with all of this going on, are they starting to get more strict again as far as who they're willing to lend their money to? As far as the mortgage, whoever funds all these mortgages and stuff, they're being a little bit more stingy with the money?
I've seen a little bit, but nothing
like before.
Ground shatter,
Yeah.
nothing that you really would make a big difference to the average buyer. But the big thing is the investors are just leery because so much has happened so fast. I mean, I think that's the biggest thing when you talk about rates is the fact that it's gone up 2 points since January.
Yeah.
That's a lot.
Yeah.
And now they're sitting here worrying about, the Fed hikes and how big are they going to be, and they're just hedging their bets, and that's why the rates have jumped so fast. And I think I've seen a little bit of that in underwriting, but I don't know what you guys have seen, but it hasn't been anything profound.
No, I think you're right. In underwriting, it's to make sure it's a sellable loan.
Right.
Yep.
That's what I've seen.
And have y'all seen a decrease in mortgage applications since in the past 2 or 3 months, or is it about the same? Or
I've seen a little bit of a decrease.
Yeah, I've seen
I
a
don't
slight.
wanna say that.
Yeah, no, I'll agree with you. I've seen a decrease myself. Actually, year over year, nationally, mortgage applications are down 41%. Now, I think Augusta, we're fortunate. I think we're a little bit protected from kind of like in the recession and in the crash in 08. We were a little protected from that just because of Fort Gordon and Plant Vogel and SRS. So I think we in this area will be a little fortunate, but overall applications are down. And if a loan officer is telling you that he's not seen a decrease, I would say that he's probably not being honest.
I don't think it's all rate though. I think a lot of it's inventory
Yeah,
too.
yeah.
I mean, if you could just, like we say, plop $150,000 houses in Augusta, I think we'd get a lot of applications.
and something I've noticed too is with the investors again, and just people buying a house. A lot of people are relocating to this area from places north and out west where cost of living is much higher and they have a whole lot more money than we do. And so then they have the money to pay cash. And so I would say probably 65% of my deals are all cash. No financing whatsoever. And
I
I'm
would
thinking,
believe that.
okay, you have $500,000, okay. Yeah, I'm used to doing that. Anyway.
Well, you don't normally spend $500,000 in cash on things?
No, I don't.
Oh, wow.
But that's something else that worries me too with the regular people like us is these people. I'm excited that they're coming here, and I'm excited that they're relocating here because then I get to brag about how great it is to live here. And but at the same time, it's kind of kicking out those, of course a seller is going to want cash over something that they could be great, as far as a borrower. They could be great, but cash is still king. And so a seller is going to jump on that and take that over, even if it's just a conventional loan with, they're paying half down and all that. They still don't care. They want the cash. So I think that's probably some of the issues too, maybe with the lack of applications too. Well, I appreciate y'all being here. I've learned some things too, so that's exciting. I spend my whole life learning, and I love to learn. And I want to tell you all that I appreciate the hard work that you do, because I know that it is a lot of times a thankless job. And you get berated, you get, blamed for things that you didn't do, and, things that are out of your control. But it's money, and that's an emotional thing for people. And so I appreciate y'all having the patience and wherewithal to handle all that, because it is I see it from my industry too. People just, it's the lack of education. And that's why I wanted to do this, is because, any kind of education I can provide to the public so that they know a little bit more than what the news is putting out there and doing fear mongering. And, I 15 articles a day. Is the bubble going to burst? No, it's not.
It is a solid bubble.
Yeah. So anyway, I appreciate what y'all do. Thank you so much for coming on. And if I was you and I was buying a house and needed to get a loan, I would contact one of the three of these, because they are the best in the area. And I enjoy working with them. And so, if I enjoy working with them, then you need to work with them too. So they make my life easy. So that's nice to have, especially in this market. But thank y'all so much. Do y'all have any final thoughts you want to plug your?
Oh, look at my notes.
I'll look at his
Oh,
notes.
wait. That was only 4 notes.
No, I just appreciate you having me on.
Yeah.
Always enjoy it.
Jeff Conzett with Colony Bank.
That would be me.
I appreciate it too.
Pam Bean with Frontline Capital Mortgage, and Cliff Jennings with Movement Mortgage. And I am Nancy Powell. I'm not with a mortgage company. I'm with Powell and Associates.
You said that like it was a bad thing.
I don't like math, just, the closing table. And getting, paid for my efforts. But, of course, I'm Nancy Powell, and I am the broker and CEO of Powell and Associates, and your host for Broker Bytes. So until next month, have a great rest of the month, and I look forward to seeing you all in June, and bringing to you another great topic. And I encourage you to have a safe and happy Memorial Day, because that comes at the end of the month. So with that said, over and out.